couple of weeks ago, the selling action in the stock market had grown so bad that a number of people thought a crash, 2008 style crash, was back on the cards. It feels pretty bad now. Crashes are rare events. They don't come along very often. The 21st century has seen 2 so far. That's rather a lot by the standards of the previous century, when there were perhaps 5 or 6 in the US over the course of 100 years. 1907, 1929, 1937, 62, 87 and 1990. It depends how you define crash, of course. You could argue that there were just 3. But anyway, crashes don't happen very often, and the probability is then that if you forecast or expect them, you're going to be wrong. And even the great short sellers who made fortunes during crashes, Jesse Livermore in 1929, I think the police are after me, Stanley Druckenmiller in 2008, they'll tell you that 90% of their fortunes were made on the long side, especially in growth stocks. Now, that's what Druckenmiller says, at least. Yet, a bit like ghosts and UFO landings, crashes make for good copy. Predicting crashes gets you lots of clicks, it gets you lots of followers. I think we all have an innate obsession with them. I thought I picked a really quiet little street to go and do this, and in fact it's about the noisiest place I've ever been, between the helicopters and the things. But the thought of a crash and losing everything lingers at the back of every investor's mind as a worst case scenario. But in any case, the selling pressure got so extreme a week or so ago that it really started to feel like a full-on crash could be on the cards. It feels like it now, to be honest, this week again. Stock markets rallied a bit, but now they're falling again. So the pressure eased, but now it's back on. But yeah, a couple of weeks ago, I can tell you I was feeling the heat. I'm feeling the heat again now, and I bet you were too. But I had a recollection in 2008 when markets had been in abject decline for some months, but the oil price kept rising. It made its way all the way to $150 a barrel, or thereabouts, you may remember, in July of that year, before it capitulated along with everything else by the autumn. And it occurred to me that something similar was happening now. Markets generally were declining while the oil price kept on rising. Now, oil price surges are driven by genuine demand, but there is always also a lot of hot speculative money in there, which means that the price rises and the sell-offs are always a bit more racy, perhaps, than they otherwise would be. But what previous crashes can tell us about what might happen next? History often rhymes, as the saying goes, so there's some value to fractal patterns, that is, looking at similar price patterns from different periods. And if you're looking to ascertain, because markets are driven by psychology, so they're useful if you're looking to ascertain how likely certain outcomes are. And I spent some time this week and at the weekend comparing the price action of various asset prices in the lead up to the crashes of 2000, 2008, the S&P 500, gold, copper, Brent crude, and the long bond. And I compared it all to the price action of recently. I could post a chart, but there are just too many squiggly lines and it's confusing. But the sequence has been as follows. Bonds made a high at the beginning of December 2021, then they relentlessly declined. Stock markets peaked at the beginning of January 2022 and then relentlessly declined. Brent, gold, copper all peaked in March, with gold and copper going into relentless decline. Oil then had another rally and peaked again in early June. Now, we were having a sort of relief rally in stocks. And then they're selling off again. So it's bonds, then stocks, then precious metals and base metals, and then oil, then the relief rally in stocks. Okay, go back to 2008. Bonds rallied as everything else crashed, so there's no correlation. But otherwise, the sequence is similar. Stocks peaked in October 2007, then gold and copper peaked March 2008, Gold then fell, copper had another rally, eventually peaking with oil in July. Then they began their fall. Stocks had a relief rally for a couple of months, and then in September of that year, we went into global freefall. So bonds aside, the sequence is similar enough to be concerning. Going back a bit to 2000, bonds peaked over a year ahead of stocks. They declined, but then they rallied as stocks fell. They're not doing it this time around. Gold peaked 6 months ahead of stocks, which peaked in March 2000, but gold was at the end of the worst bear market ever, so I'm not even sure comparisons are valid. But then copper and oil peaked shortly after. Stocks retested their highs in October 2000. So leaving aside bonds, there's a definite sequence of stocks peaking, followed by base metals and oil a few months after, then the big declines. So we're sort of following a similar sequence now, but I'm not sure how much you can read into it. But sentiment was so low 2 weeks ago, markets were so oversold that there was a part of me that was thinking we'd already seen the low. Maybe we're just retesting that now. But I'm also, the relief rallies are so pathetic, and weakness in energy and metals, maybe not so much energy, but metals is so close to the 2008 template, and to an extent the 2000 template. So all in all, I think the verdict is stay defensive, stay in cash, maybe not time at the moment to bet the house just yet. For a quiet road, cars drive very fast down here. Anyway, thank you very much for watching. Stay defensive. Look after cash. There'll be a time again when everything goes up, but core markets are difficult at the moment. Anyway, thanks for watching. Please subscribe to the channel. Please subscribe to my Substack. I'll post a link there, and I'll be back with another video very soon. Goodbye.